Gold and crypto, a fair match between the eternal metal and digital gold. Imagine waking up in the morning, going to your bank, and the doors are closed. Not for an hour, not for a day, but indefinitely. It's March 2013 in Nicosia, Cyprus. People are standing in front of shuttered bank branches. The line doesn't move. On the glass, a sign reads, "Temporarily closed. Cash withdrawals limited." Money that felt safe in the bank yesterday is suddenly unreachable today, and on that same street, something else happens. Informal exchange points appear almost overnight. Under the table, gold coins are being traded, and for many people, Bitcoin for the very first time. Two completely different systems, one old, one new. One goal, survive a financial lockdown when the system stops working. Then and now, gold and Bitcoin today. Fast forward 20 years, and the story didn't end. It evolved. Today, central banks around the world are quietly accumulating physical gold, not because they are nostalgic, but because they understand systemic risk. At the same time, something historic happens on the other side of finance. Wall Street opens the door to spot Bitcoin ETFs. Bitcoin enters pension funds, institutional portfolios, and the traditional financial system. This isn't about choosing a winner, it's about two answers to the same question. Metal with no counterparty or code with no bank. Size and liquidity, gold versus Bitcoin. If I had to use a metaphor, gold is an ocean. Bitcoin is a fast-growing river. Gold has been here for thousands of years. You find it in Indian wedding jewelry, in central bank vaults, in private safes, and in physically backed ETFs. Its liquidity is deep, global, and tested across centuries. Bitcoin tells a different story. It started in 2009 as a small experiment and grew into a global network with a fixed supply of 21 million units reinforced by periodic halvings. Gold is deep, broad, and stable. Bitcoin is fast, continuous, and still being domesticated. Both are powerful, in very different ways. How trading works. This is where the differences become very practical. Gold trades almost around the clock. London, Zurich, New York, Shanghai, 24 hours a day, 5 days a week. In calm times and in crises, there is almost always a buyer, a seller, or a lender. Bitcoin goes one step further. It trades 24/7. No weekends, no holidays, no market close. The world can stop. The network doesn't. And then come the ETFs. For many investors, this means exposure without wallets, without private keys, just a ticker symbol and a click. A bridge between the old system and the new one. Who trusts gold? When things really go wrong, the biggest players in the world all turn to the same asset. States and central banks trust gold, not because it's fashionable, but because it works when systems are under stress. Gold has no counterparty risk. It doesn't depend on a bank, a government promise, or a payment network. It is politically neutral and globally accepted, regardless of who is in power. In a crisis, gold can be pledged for liquidity, physically repatriated, or used as collateral when other assets fail. That's why central banks hold gold even when markets are calm and bonds still pay interest. Gold isn't about returns. It's about sovereignty and survival. Who trusts Bitcoin? Bitcoin attracts a very different kind of trust from a very different group of people. Bitcoin is trusted mainly by individuals, investment funds, and technology optimists who believe in digital scarcity. For them, Bitcoin is not just an asset, it's a tool. It allows value to move across borders, without banks, without SWIFT, without asking permission. All you need is an internet connection. Many also see Bitcoin as a hedge against monetary experimentation, against excessive money printing, capital controls, or sudden rule changes. In short, gold protects the system. Bitcoin challenges it. The gray zone, combining both. But the most interesting group doesn't choose sides. More and more family offices are combining gold and Bitcoin in the same portfolio. Why? Because they prepare for two different futures. Gold is there for the worst-case scenario, systemic crisis, geopolitical shocks, loss of trust. Bitcoin is there for the best-case scenario, technological adoption, digital scarcity, and asymmetric growth. This isn't ideology, it's risk management, not faith in one outcome, but readiness for several. Volatility, parachute versus rocket. Gold and Bitcoin move very differently because they're built for different jobs. Gold has repeatedly proven itself as a portfolio stabilizer. When markets panic, geopolitics heat up, or real interest rates fall, gold often acts like a parachute. It slows the fall when everything else drops fast. Bitcoin, on the other hand, behaves more like a rocket. It has high volatility and high beta. In favorable conditions, it can move dramatically upward. But turbulence is part of the ride. That's why these two assets are not direct competitors. They play different roles. One is designed to reduce damage, the other is designed to capture upside. Correlation and risk. Correlation is not fixed. It changes with the environment. Gold often performs well when real interest rates fall or when uncertainty rises. In those moments, investors look for protection rather than growth. Bitcoin usually behaves like a risk asset. In risk-on periods, it may move alongside equities. In risk-off periods, it can drop, sometimes sharply, but Bitcoin can also decouple. At times, it moves up independently when digital scarcity is rewarded. At other times, it falls on crypto-specific shocks. Direction isn't guaranteed. Independence cuts both ways. Energy and ESG. Bitcoin. Bitcoin security is paid for with energy, and that's both its strength and its controversy. Bitcoin relies on proof of work, which consumes significant amounts of electricity to secure the network. Critics focus on energy usage. Supporters point out that mining increasingly uses surplus and stranded energy, hydro, wind, or gas that would otherwise be wasted. The reality sits in between. Bitcoin mining is becoming more transparent, more scrutinized, and more regulated, but this evolution is still ongoing. Energy and ESG. Gold. Gold's environmental footprint is older and easier to understand. Gold's impact comes mainly from mining and refining. Those processes are energy intensive, but they come with an important offset: recycling. Old jewelry, coins, and industrial gold continuously re-enter the system, reducing the need for new extraction. At the same time, ESG standards and traceability are improving. From conflict-free sourcing to certified refineries, the gold industry is adapting to modern environmental and ethical expectations. Custody. Bitcoin. With Bitcoin, ownership is freedom, but freedom comes with responsibility. Self-custody gives you full control. No bank, no intermediary, no permission needed. But it also means full responsibility. Lose the private keys and the funds are gone forever. To reduce that risk, many use multi-signature setups. Instead of one key, you might need 2 out of 3, which protects against theft, loss, or human error. Others choose Bitcoin ETFs. They offer price exposure without managing keys or wallets. You trade convenience for sovereignty, and for some investors, that trade-off makes sense. Custody. Gold. Gold ownership is physical, and that changes everything. Physical gold needs secure storage. That can mean a home safe, a bank box, or a professional vault, plus insurance, documentation, and authenticity checks. A critical distinction is allocated versus unallocated gold. Allocated means a specific bar or coin is legally yours. Unallocated means you own a claim, not the metal itself. Gold ETFs are highly liquid and efficient, but in a crisis, they remain paper gold, not something you can physically hold. Best practices. Most investment failures don't come from bad ideas. They come from bad custody. For Bitcoin, best practice means cold storage, multi-sig where appropriate, and secure tested backups stored separately. For gold, it means buying standard, widely recognized coins, keeping invoices, and using reputable custodians or vaults. Because one mistake, a lost key, a fake coin, an unreliable custodian can destroy an otherwise sound strategy. Custody isn't a detail, it's half of the investment outcome. Strategy. A. Stable core. This strategy is for people who value sleep more than excitement. The stable core focuses on capital preservation and peace of mind. The goal is not to win every year, but to stay in the game through all market cycles. The backbone is a mix of bonds and equities, providing income and long-term growth. Gold plays a small but important role, as insurance when uncertainty rises. Bitcoin, if included at all, remains a minor long-term option. Not a conviction bet, but a carefully sized exposure to potential technological upside. Strategy B. Barbell. Here, caution and ambition coexist. The barbell strategy combines a conservative core with bold growth exposure. Gold provides stability on one side of the barbell. Bitcoin sits on the other, offering a symmetric upside with the understanding that volatility is part of the deal. The key element is discipline. Predefined rules: when to add, when to trim, keep emotions from taking control during market euphoria or panic. Strategy C. Robust mobility. This strategy is not about returns, it's about access. Robust mobility is designed for unstable or high-risk environments where systems may fail or borders may suddenly matter. Physical gold acts as an offline emergency asset, recognizable, liquid, and independent of technology. Bitcoin provides mobility. It allows value to move across borders quickly, without banks, and without relying on local financial infrastructure. This strategy isn't theoretical, it's built for the real world when flexibility becomes survival. Real life, Cyprus, 2013. Cyprus 2013 was the moment many people learned that money in the bank is not always your money. Overnight, bank deposits were taxed. Savings that families had built for years were suddenly locked and partially confiscated by emergency rules. Some people turned to gold, using coins for direct payments when the banking system froze. No terminals, no approvals, just trust and immediate exchange. At the same time, Bitcoin enabled rent payments from abroad. Funds sent digitally crossed borders when banks couldn't, keeping daily life moving while the system stood still. Real life, Venezuela and India. In long-running crises, survival becomes more important than ideology. In Venezuela, crypto enables remittances under strict capital controls. Traditional transfers are slow, expensive, or blocked, while digital assets move faster and more reliably. In India, gold jewelry acts as social and financial capital. When times are good, it represents tradition and honor. When times are hard, it becomes working capital, melted, sold, or pledged to keep businesses alive. In moments like these, theory doesn't matter. What works, works. Real life, Ukraine 2022. War compresses financial decisions into hours, sometimes minutes. In 2022, banks were closed and payment cards stopped working across borders. Access, not yield, became the priority. People exchanged gold for cash and transport, a bus ticket, a meal, a safe place to sleep. At the same time, crypto was used for donations and aid. Funds reached people directly, quickly, and without bureaucracy. When traditional channels failed, not perfect, but enough. Common mistakes. Most people don't fail because markets are unfair. They fail because they make the same mistakes again and again. The first mistake is going all in on a single asset. History is clear. Concentration feels smart in good times and brutal in bad ones. The second is buying at euphoric market tops. Both gold and Bitcoin move in cycles. Chasing headlines usually means buying excitement, not value. And the third mistake is ignoring custody and counterparty risk. An asset you can't access when you need it is not a safe asset. It's a promise. Operational risks. Risk doesn't always come from price. Often it comes from operations. With gold, the risk can be counterfeits or unreliable dealers. Saving a small fee can lead to the most expensive lesson of all. With crypto, history is full of exchange and custodian failures. Assets disappeared not because prices fell, but because intermediaries collapsed. And many investors forget taxes and regulation. Rules differ by country, and crypto adds reporting obligations. Ignoring this can turn profits into problems. What safe means depends. There is no universal definition of safety. It depends on who you are. For a retiree, safety means calm, predictable cash flows and low volatility. Gold might play a small role, Bitcoin often none, or very little. A young saver thinks in decades. Growth matters and volatility is acceptable. Equities and some Bitcoin make sense with gold as a counterweight. An entrepreneur thinks operationally. How fast can I access funds? How flexible is my capital? Gold for offline scenarios, Bitcoin for mobility, and cash to pay Monday's invoices. Final summary. So what's the takeaway? Gold is the analog foundation. It offers no yield, makes no promises, and owes nothing to anyone. Bitcoin is a digital option. It can succeed spectacularly or fail painfully. That's why position size matters. This was never about either or. It's about how much and why. And in the end, one rule applies to both. Good custody is half the result.